Good afternoon, everybody. Welcome again to the New York Fed's quarterly regional economic press briefing. I'm pleased to have the opportunity to talk with you and through you to people in our district. This afternoon, I'm going to focus on regional economic conditions with particular attention, as Jack said, to job polarization, which I would define as the expansion of the number of jobs at the upper end and lower ends of the wage and skill distribution, and a shrinking of job opportunities in the middle. We will see how these trends are playing out in our region. As always, what I have to say reflects my own views, not necessarily those of the Federal Open Market Committee or the Federal Reserve System. Turning to national economic conditions, the U.S. economy is continuing to slowly recover from the after effects of the housing boom and bust and the financial crisis. But the recovery has been disappointing. Indeed, when we look at economic forecasts over the past 3 or 4 years, it's notable that growth has fallen systematically short of both the Federal Reserve's and private sector forecasts. Despite what's been an unusually accommodative monetary policy by historical standards, the economy has grown at only a 2.1% annual rate over the last 4 quarters. And the blue chip consensus forecast anticipates only a very modest acceleration to 2.4% growth over the next 4 quarters. The headwinds retarding the recovery are well known. Consumers have been deleveraging in response to the large losses in wealth generated by the large collapse in home prices. Housing activity remains depressed for many reasons. These include the large shadow inventory making its way through the foreclosure pipeline, tight underwriting standards for new mortgage origination, and the sharp slowdown in household formation. Although the corporate sector as a whole is now reasonably healthy, there's still a significant constraint on the availability of credit to small business. And fiscal policy has become restrictive as state and local governments have cut expenditures in response to revenue shortfalls. And there's also the uncertainty about how Congress and the administration will address the 2013 so-called fiscal cliff, and that's likely to inhibit hiring and investment by business. Global economic growth has also slowed as European activity has stagnated, and this is capping the demand for U.S. exports. On the brighter side, some of these headwinds do appear to be subsiding. Employment growth, if you look over the last 6 months, has picked up. And this should eventually lead to faster growth in household formation and more demand for housing. U.S. banks are healthier, so that credit conditions, while still tight, are gradually easing. And households appear quite far along in the deleveraging process by a number of important measures. For example, if you look at the ratio of household debt service relative to income, we've fallen all the way back to levels last seen in the early 1990s. So for these reasons, I do expect that growth will gradually strengthen over the next few years. Nevertheless, significant downside risks remain, especially those related to the challenges in Europe and how the potential fiscal cliff in the United States will be resolved after the fall elections. But even if these risks do not materialize, I anticipate only slow progress back towards full employment. On the inflation side, in recent years, our forecasts have been noticeably more accurate than on the growth side, and we've succeeded in delivering inflation very close to our 2% price stability objective. Through March, as measured by the personal consumption expenditure deflator, overall consumer prices have risen 2.1% over the last 12 months, and prices excluding food and energy have risen 2.0%, so right on target. But it's true that price trends have been a bit stickier than one might have anticipated given the large slack in the economy. Now, to some degree, this likely reflects the anchoring exerted by stable inflation expectations. But some of the things that are holding prices up around 2% can be attributed to other more temporary factors. For example, higher oil and gasoline prices and their pass-through in the cost of other goods and services. For example, the upward pressure on imputed homeowners' rents due to the increased demand for rental housing and the effects on rents. And third, higher import prices for goods such as apparel. This presumably reflects many factors, including commodity price pressures and higher wage inflation in countries such as China. Now, some of these upward pressures on inflation do appear to be fading. Oil and gasoline prices, for example, have fallen in recent months. And apparel price inflation should gradually ease given the sharp drop that we've seen in cotton prices. Even owners' equivalent rent should also eventually stabilize as we see a pickup in multifamily construction and as programs that shift real estate that's currently owned by banks back into the hands of investors so that that real estate can be rented up. As those programs gear up, that should be helpful. More generally, there are several reasons to think that inflation will remain moderate and close to our objective. First, and most obviously, the economy continues to operate with significant slack. Second, measures of underlying inflation show little upward pressure. The Federal Reserve Bank of New York has developed a gauge called the underlying inflation gauge, which is actually turning down right now. So it shows inflation pressures are actually diminishing. This measure is based on a wide set of variables to forecast the underlying inflation trend. Third, it's hard to be very concerned about inflation risks when the growth rate of nominal labor compensation is so low and stable. To me, it's quite noteworthy that the employment cost index has only risen 2.1% over the last 4 quarters, and it hasn't shown any signs of acceleration. And fourth, inflation expectations remain well anchored. This is particularly important because inflation expectations are an important driver of actual inflation outcomes. So taking all this into account in terms of the current stance of monetary policy, I anticipate that inflation will decline to slightly below our 2% long-run objective over the next few years. So what does this all imply for monetary policy? Well, not surprisingly, I currently anticipate that the Federal Reserve's federal funds rate target will remain exceptionally low, that is, at the current level, at least through late 2014. Now, given our forecast of stable prices and a still slow path back to full employment, there is an argument for easing monetary policy further. But unfortunately, our tools have costs associated with them as well as benefits, so we have to weigh these costs against the benefits of further action. As long as the U.S. economy continues to grow sufficiently fast to cut into the nation's unused economic resources at a meaningful pace, I think the benefits of further action are unlikely to exceed the costs. But if the economy were to slow so that we're no longer making material progress towards full employment, or if the downside risk to growth were to increase sharply, or if deflation risks were to decline materially, then the benefits of further accommodation would increase in my estimation. And this could tilt the balance in the direction towards additional easing. Now, under such circumstances, further balance sheet action might be called for. We could choose either between further extension of the duration of the Fed's existing Treasury portfolio versus another large-scale asset purchase program of Treasuries or agency mortgage-backed securities. Conversely, I would be willing to consider tightening policy at a somewhat earlier stage if growth strengthens sufficiently to materially improve the medium-term outlook and substantially reduce tail risks, or if there was evidence of a genuine threat to medium-term inflation, including a rise in inflation expectations. In such a case, I anticipate that the first step would be to bring in the late 2014 date of policy guidance. This would effectively tighten financial conditions, not only by changing the expected path of short-term interest rates, but also by bringing forward the start of balance sheet normalization. So let me now turn to the regional economy, the focus of our presentations today. Since our last briefing, the recovery in the region has picked up some steam. As attendees at previous regional press briefings may recall, the bank produces economic activity indexes to help us monitor the performances of the regional economy. Based on these measures, activity in New York State and New York City has continued to expand at a healthy clip, while New Jersey's growth rate continues at a more moderate pace. In Puerto Rico, the activity index produced by the Government Development Bank for Puerto Rico shows that the island's downturn does appear to have ended, but the pickup, the very tentative pickup that we noticed at our last briefing has not persisted, and so the level of activity there has stalled at a constant level. Looking at payroll employment, however, the pattern of recovery is actually a bit more positive, though mixed across the region. New York State and New York City saw faster job growth in the nation since our last briefing. Job creation in the city has been particularly robust, and employment in the city now is above its pre-recession peak. In New Jersey, however, employment stands only slightly above where we were at the time of the last briefing and still well below its previous peak. And in Puerto Rico, employment continues to fluctuate near its lows with no sign of a pickup yet. So let me turn to the special topic today, which is the issue of job polarization. As I've visited various parts of the district, most recently Long Island, Syracuse, and Buffalo, employers have told me that they're beginning to add jobs, particularly in the high-tech areas. These jobs can be best characterized as highly skilled and technologically advanced. And I've heard very similar stories from our Small Business Advisory Council, our Upstate Advisory Council, and even from our community banks. These anecdotes are reflected in our research on labor market dynamics. Over the past 3 decades, job opportunities have become increasingly concentrated in high-wage, high-skill occupations and in low-wage, low-skill occupations, while job opportunities for those in the middle have been shrinking. At the same time, there's been a growing gap in the wages between the jobs that pay the most and those that pay the least. Taken together, this phenomenon is referred to as job polarization. The root causes of job polarization appear to be mainly technology and globalization, which has displaced many jobs, particularly those involving routine tasks. This loss of jobs has been especially pronounced for what we often think of as traditional middle-skilled workers. Its impact is perhaps most evident in the manufacturing sector, where so many jobs have been lost in recent decades. Given the strong history of manufacturing in our region, job polarization has been an important feature of the local economy for some time. No doubt the widening wage gap and the loss of job opportunities for middle-skilled workers has contributed to the rise in economic inequality and has created challenges for many workers and their families. More than ever before, jobs are requiring a greater degree of knowledge and skill. In order to adapt to these changes, it's increasingly important for workers to acquire and upgrade their skills, whether through formal education or other forms of training. In addition, it's important for employers to communicate what they need in terms of employment skills to the educational institutions so that those educational institutions can offer the coursework and programs so that people can develop the right skills to fit into the available jobs. For these reasons, we think it's particularly important to highlight these trends in today's briefing. So to sum up, recent data are consistent with an expectation of moderate growth in 2012 and slightly stronger growth looking forward into 2013. I also expect both headline and core inflation rates should come down over the next few months. In our region, the recovery of activity and employment has continued, although the data indicate different performances across the region, relatively strong performances in New York State and New Jersey, in New York City compared to New Jersey, and while Puerto Rico has yet to show any meaningful improvement. Our special topic shows that a trend of job polarization both in the nation and the region, and that focuses our attention on the ever-growing importance for workers to acquire skills and to upgrade their skills on an ongoing basis.